Most people start with the wrong idea about money, and once that mistake is made, everything that follows gets distorted. They believe wealth comes from brilliance, from speed, from being early, clever, or bold. That belief is false. If there is one lesson I've learned over a lifetime of watching people succeed and fail, it is this. Getting rich is not about brilliance. It is about avoiding stupidity. That sounds obvious, almost insulting, yet almost no one behaves as if it were true. Stupidity usually does not look stupid in the moment. It looks exciting. It looks urgent. It looks like opportunity knocking and warning you that if you hesitate, someone else will take what should have been yours. That sense of urgency is where most financial disasters begin. I have lived long enough to see the same pattern repeat over and over, in different decades, with different stories, but always with the same ending. In the 1920s, people believed the stock market was a machine that only went up. In the 1990s, they believed the internet had repealed the laws of economics. In 2008, they believed housing prices could never fall. Different decades, same delusion. People convince themselves that the old rules no longer apply, that caution is outdated, that patience is unnecessary, and then reality returns. The truth is not complicated. If you avoid blowing yourself up, wealth has a way of creeping up on you quietly, not because you are especially smart, but because you stayed alive long enough for compounding to work. I grew up during the Great Depression. It was not a theory to me, it was daily life. I watched families lose everything, not because they were lazy or foolish, but because they took on too much risk when times were good. They assumed the future would look like the present. When it didn't, they were wiped out. That experience burned one idea into me early. Never depend on things staying wonderful. Assume trouble will come. Assume markets will fall. Assume people will behave badly under pressure. If you build your financial life around that assumption, you immediately gain an advantage over most people. The majority plan as if the good times will last forever. They borrow against optimism. They spend against expectations. They design lives that only work if nothing goes wrong. That is not a plan. It is a gamble. Warren Buffett and I did not build Berkshire Hathaway through brilliance or speed. We built it slowly, brick by brick, deal by deal. No fireworks, no genius moves, just patience that most people find unbearable. If you want excitement, there are plenty of places to find it. Casinos are open all night. Markets will happily give you adrenaline, but excitement and wealth rarely live in the same house for long. The crowd does not want to hear this. They want shortcuts. They want tricks. They want someone to tell them how to get rich fast without paying the price of discipline or time. Shortcuts in money usually lead to long detours and misery. I have seen men with enormous incomes destroy themselves because they could not sit still. And I have seen very ordinary people grow wealthy simply by saving steadily and owning productive assets for decades. The difference was not intelligence. It was temperament. The fastest way to get rich is to stop trying to get rich fast. I did not plan to become a billionaire. I simply stayed rational longer than most people. I avoided envy. I avoided debt. I avoided drama. And I let compounding do the work. If that sounds dull, good. Dull is safe. Dull survives. This entire discussion rests on one simple idea. The first rule of compounding is that you must not interrupt it. And the fastest way to interrupt it is to lose money in a way you cannot recover from. Everything else is commentary. If you want to understand why so many intelligent people fail financially, you have to start with one uncomfortable truth. Survival comes before success. Compounding only works if you are still standing. That idea sounds simple, but it is ignored constantly. People obsess over returns while ignoring the risk of ruin. They ask how much they can make without asking how much they can lose. One large mistake can erase decades of careful progress. This is not theory. I have watched it happen repeatedly. A lifetime of discipline can be wiped out by one episode of leverage, one burst of overconfidence, or one moment of panic. The math is unforgiving. Lose 50% of your capital, and you need 100% gain just to get back to where you started. Lose more than that, and recovery becomes unlikely. Lose everything, and the game is over. That is why not losing is more important than winning. People hate hearing this because it sounds timid. They want boldness. They want action. They want stories of dramatic success. But markets do not reward drama. They reward endurance. The biggest fortunes I have seen were not built by people who took wild risks. They were built by people who made sure they could survive bad outcomes. Margin of safety is not an academic concept. It is a way of living. It means keeping expenses low enough that a downturn does not destroy you. It means avoiding debt that forces you to sell at the worst possible time. It means accepting lower returns in exchange for durability. When people hear that, they think it means giving up upside. What it really means is protecting the downside. If the downside is protected, the upside takes care of itself over time. I learned this early, not from books, but from watching people who assumed tomorrow would look like today. When conditions changed, they had no room to maneuver. They were trapped by obligations they could not escape. Survival gives you options. Optionality is the real source of power in investing and in life. If you are not forced to act, you can wait. If you can wait, you can choose. If you can choose, you can compound. Most people reverse that order. They lock themselves into fragile situations and then hope intelligence will save them. It rarely does. Intelligence does not help much when you are forced to sell. It does not help when creditors are calling. It does not help when fear takes over. Staying in the game requires humility. It requires accepting that bad luck exists and that markets do not care about your confidence. The people who survive are not the ones who predict every storm. They are the ones who build shelters strong enough to endure them. Warren Buffett and I never tried to eliminate risk. We tried to avoid risks that could kill us. There is a difference. You do not need to avoid every mistake. You just need to avoid the ones that cannot be fixed. Survival is not glamorous. It does not make headlines, but it is the foundation of every long-term success story. If you remember nothing else, remember this. You cannot compound what does not exist, and the first duty of capital is to survive. Impatience is the silent destroyer of wealth, and it usually disguises itself as ambition. People like to believe they are impatient because they want to improve their lives quickly, but that is not what is really happening. What they want is relief from discomfort. They want visible progress. They want proof that their effort is working. And when they do not get that proof fast enough, they abandon the process. This is where most financial plans fail, not because the plan was wrong, but because the person could not tolerate the waiting. Compounding is deeply unintuitive to the human brain. In the early years, nothing seems to happen. You save, you invest, and the numbers barely move. The effort feels disproportionate to the reward. That is why the beginning feels so frustrating. People look at their accounts and think the whole exercise is pointless. They forget that compounding does not reveal itself gradually. It reveals itself suddenly, after years of apparent stagnation. The first phase is all discipline and no reward. The second phase is less discipline and visible reward. The third phase is where the machine finally starts working harder than you do. Most people quit in the first phase. They assume something is wrong because the results are boring. They underestimate how much time is required for momentum to build. This is especially true with the first meaningful amount of capital. When the base is small, the returns are mathematically small. There is no way around that. No strategy can change arithmetic. The early years require faith and logic rather than emotion. You have to trust that slow progress is still progress. Impatience pushes people into shortcuts precisely at the moment when patience matters most. They start chasing higher returns, riskier assets, or fashionable ideas because waiting feels unbearable. They confuse activity with progress. They trade boredom for excitement without realizing they are trading durability for fragility. I have watched countless people sabotage themselves this way. They were doing fine until they got tired of doing nothing. That boredom became intolerable, so they reached for something clever. Cleverness is often where compounding goes to die. The irony is that waiting is not passive. Waiting is an active decision to let time do the heavy lifting. It requires emotional control, It requires resisting the urge to constantly intervene. The market does not pay you for effort. It pays you for being right and for being patient. Those two rarely arrive at the same time. People also misunderstand time itself. They treat it as something to be endured rather than something to be harnessed. Time is not the enemy of wealth. Impatience is. Time magnifies whatever behavior you repeat. If you repeat disciplined saving and rational investing, time multiplies the result. If you repeat impulsive decisions and emotional reactions, time multiplies the damage. This is why temperament matters more than intelligence. A very smart person who cannot wait will underperform an average person who can. I have seen this over and over again. The smartest minds often struggle the most because they believe they should be able to speed things up. They overestimate their ability to outthink reality. Reality does not negotiate, it compounds at its own pace. Another trap of impatience is comparison. When people see others getting rich faster, they assume they are falling behind. They forget that outcomes are not synchronized. Everyone's timeline is different. Some people take more risk and get lucky early. That does not make their approach superior. It makes it fragile. Fast gains often come with hidden risks that only show up later. The long game feels lonely because there is no applause along the way. Nobody congratulates you for sitting still, saving quietly, and doing nothing dramatic. That lack of feedback makes people doubt themselves. They mistake silence for failure. The truth is that silence is exactly what compounding looks like in the early stages. If you can learn to tolerate that silence, you gain a massive advantage. Waiting is work. It is emotional labor. It is the ability to delay gratification long enough for arithmetic to overwhelm impulse. The people who succeed are not the ones who move first. They are the ones who stay last. They do not rush the process because they understand that rushing is the only reliable way to break it. If you want wealth to grow, you must give it time. And if you want to give it time, you must conquer impatience. Everything else is secondary. Envy is one of the most destructive forces in financial life, and it operates quietly enough that most people never recognize it for what it is. I have called envy the dumbest of all sins, and I stand by that description. Other vices, at least, offer some temporary pleasure. Envy offers nothing. It only corrodes judgment and creates misery. In money, envy does more damage than ignorance. An ignorant person can learn. An envious person usually cannot, because envy shifts the focus away from reality and toward comparison. Once comparison becomes the reference point, rational decision-making disappears. People stop asking whether an action makes sense for them and start asking whether it makes them look successful relative to others. That is how sensible plans get abandoned. Envy turns investing into a scoreboard, and scoreboards are a terrible way to manage capital. I have watched this play out for decades. People do not buy assets because they understand them. They buy them because someone else made money on them. They do not increase risk because the odds are attractive. They increase risk because they feel left behind. This is how bubbles form. The mechanics are always the same. A small group gets rich early. Their success becomes visible. Others feel foolish for missing out. Envy disguises itself as opportunity, and suddenly large numbers of people rush into things they do not understand at prices that make no sense. At that point, reason has already left the room. What follows is always painful. When the inevitable collapse comes, envy does not disappear. It simply changes form. People blame markets, institutions, or bad luck, but the real cause was internal. They were playing a game they never needed to play. One of the most important skills in life is learning to define your own game. If you do not define it, you will end up playing someone else's, usually badly. Financial. Envy convinces people that there is a universal race and that falling behind is a form of failure. That belief is false. Wealth is not a race with a single finish line. It is a process of building enough security, independence, and peace of mind for your own life. Someone else getting richer faster does not reduce your chances of doing well. It is irrelevant. Yet envy makes it feel personal. I have seen people with perfectly adequate financial situations destroy themselves because they could not tolerate the idea that someone else was doing better. They took risks they never needed to take. They abandoned strategies that were working. They traded long-term stability for short-term validation. Envy also infects spending behavior. People buy things not because those things improve their lives, but because they signal success to others. This creates a cycle of consumption that is almost impossible to sustain. As income rises, expectations rise faster. Satisfaction never arrives because comparison never ends. There will always be someone with more money, a bigger house, or a better story. If that is your reference point, you will never feel rich, no matter how much you have. I never cared if Warren Buffett made more money than I did. Of course he did. That fact had no bearing on the quality of my life. I had enough. I lived comfortably. I slept well. That is the only scoreboard that matters. Envy blinds people to the power of time. When you are focused on what others are doing today, you stop thinking about where you will be in 20 or 30 years. Compounding does not reward people who chase what looks good now. It rewards people who stick with sound decisions long enough for results to accumulate. Envy interrupts that process. It injects urgency where patience is required. It pushes people to act when they should be waiting. The cure for envy is not motivation or affirmation. It is perspective. You must remind yourself that you are playing a long game and that most people are not even trying to finish. Many will drop out along the way because they cannot tolerate boredom or uncertainty. If you can avoid envy, you gain an enormous advantage. You stop making decisions to impress others. You stop taking risks to satisfy ego. You start making choices based on durability rather than appearance. That shift alone can determine the difference between a life of quiet security and one of constant anxiety. Envy has never made anyone rich, but it has made many people poor. The rational response is simple. Stop looking at the scoreboard. Focus on staying in the game. Over time, that discipline compounds in ways envy never will. Debt is one of those things that looks harmless when everything is going well and becomes lethal the moment conditions change. People talk about leverage as if it were a tool, something neutral that only depends on how skillfully it is used. That is a comforting story, and it is mostly wrong. Debt does not simply magnify outcomes. It removes options. The moment you take on obligations you cannot easily escape, you give up control over timing. And timing is everything in finance. When you owe money, you lose the ability to wait. You lose the ability to be patient. You lose the ability to sit through bad periods calmly. Instead, you are forced to act on someone else's schedule, and forced action is almost always the worst kind. I have watched this play out again and again. People borrow when times are good because borrowing feels safe. Income is steady. Asset prices are rising. Credit is easy. Under those conditions, debt feels like intelligence. It feels efficient. It feels like you are finally being bold. Then conditions change. They always do. Markets fall, jobs disappear, cash flows shrink. Suddenly, the same debt that looked manageable becomes suffocating. At that point, intelligence no longer matters. You may know exactly what the right long-term decision is, but you cannot take it because you are trapped. You must sell when prices are low. You must liquidate good assets to satisfy short-term demands. That is how debt converts temporary problems into permanent damage. One of the most important lessons I learned growing up during the Great Depression was that debt turns volatility into catastrophe. Families who had no debt struggled, but they survived. Families who were leveraged were wiped out. The difference had nothing to do with character or effort. It had everything to do with fragility. Debt makes you fragile. It ties your fate to conditions you cannot control. People often defend debt by pointing out that it can increase returns. That is true in narrow, controlled situations. What they ignore is that debt also increases the probability of ruin. And ruin is not something you can average out over time. You only need one wipeout to end the game. That is why I have always preferred a little less upside in exchange for a lot more durability. Independence is real wealth. If you can cover your expenses without relying on constant optimism, you sleep better. If you do not owe anyone money, you are harder to push around. You can say no. You can wait. You can think clearly. Debt interferes with all of that. It introduces fear into decision making, and fear is poison to rational judgment. People under financial pressure do not make better decisions, they make faster ones. Fast decisions under stress are rarely good decisions. Another problem with debt is that it encourages self-deception. People borrow based on best-case scenarios. They assume income will remain stable. They assume markets will recover quickly. They assume nothing unusual will happen. History suggests otherwise. The world is full of surprises, and most of them are unpleasant. A sensible financial life assumes adversity will arrive and prepares accordingly. That preparation usually means living below your means and keeping obligations manageable. It means resisting the temptation to stretch just because credit is available. Availability is not the same as affordability. Banks are perfectly willing to lend you enough money to make you fragile. That does not mean you should accept the offer. I have seen brilliant people lose everything because they confused leverage with intelligence. They thought borrowing made them sophisticated. In reality, it made them dependent. Once you depend on conditions staying favorable, you are no longer in control. Warren Buffett and I have always believed that a strong balance sheet is a competitive advantage. Low debt and ample liquidity look boring when times are good. When times are bad, they look like genius. That is not because of foresight. It is because of humility. We assumed we could be wrong. We assumed bad luck could show up. We structured our lives and our businesses so that those events would not destroy us. That is the essence of avoiding loss. You do not need debt to build a good life. You need discipline. You need patience. You need the willingness to say no when saying yes feels exciting. Debt promises speed. What it usually delivers is fragility. If your goal is to never lose money in a way you cannot recover from, then avoiding unnecessary debt is not optional. It is foundational. Overconfidence is one of the most reliable ways intelligent people destroy themselves, and it rarely announces itself openly. It usually shows up as certainty. The belief that you understand more than you actually do, the belief that your opinion deserves action, the belief that past success proves future correctness. I have spent my life trying to do the opposite. I want to know precisely where my knowledge ends, because that boundary is where safety begins. Most people never bother to draw that boundary. They form opinions on businesses, markets, politics, and technology with astonishing speed, and then defend those opinions as if their identity depends on it. The less they know, the louder they argue. This is not just a social problem. It is a financial one. Markets punish overconfidence relentlessly. They do not care how smart you feel. They only care whether your decisions are aligned with reality. One of the most valuable phrases in my vocabulary has always been, "I don't know." That phrase has probably saved me more money than any clever insight I ever had. Saying, "I don't know," keeps you out of trouble. It prevents you from wandering into fields where you have no edge. It stops you from betting on outcomes you cannot reasonably predict. Yet people hate saying it because it feels like weakness. In reality, it is strength. Overconfidence pushes people to play games they were never equipped to win. They believe they must have an opinion on everything: oil prices, interest rates, technology trends, foreign markets. Most of these areas require deep, specialized knowledge, and even experts get them wrong regularly. When amateurs jump in with confidence, the outcome is predictable. I have seen entire fortunes evaporate because someone thought understanding a headline was the same as understanding a business. Knowing the name of something is not the same as knowing how it works. This is why the concept of a circle of competence matters so much. You do not need to know everything. You just need to know what you actually understand and stay inside those boundaries. That discipline alone eliminates a vast number of potential mistakes. Warren Buffett and I ignored most opportunities that came our way, not because they were bad, but because we did not understand them well enough. People thought that made us slow or outdated. What it made us was solvent. The irony is that overconfidence feels productive. You feel engaged. You feel decisive. You feel like you are participating. Humility feels passive by comparison. You sit out. You wait, you pass. From the outside, it looks like inaction. From the inside, it is risk management. Overconfidence also creates a dangerous attachment to being right. Once people commit publicly to an opinion, they start defending it emotionally. Evidence becomes the enemy. Admitting error feels humiliating, so they double down instead. This is how small mistakes turn into large ones. Pride keeps people from cutting losses early. Pride keeps them invested in failing ideas long after the logic has collapsed. I have seen this pattern everywhere, not just in investing. Businesses fail because leaders cannot admit they were wrong. Relationships fail for the same reason. Overconfidence locks people into paths they should abandon. Humility keeps paths open. Another problem with overconfidence is that it encourages unnecessary complexity. People try to prove how smart they are by building elaborate theories and systems. Complexity feels sophisticated. In reality, it often hides ignorance. The more complex an explanation becomes, the harder it is to notice when it stops making sense. Simple ideas fail fast. Complex ideas fail slowly and expensively. I prefer simple reasoning that I can explain plainly, if I cannot explain. Why something should work without jargon, I assume I do not understand it well enough to risk money on it. That rule has kept me out of countless disasters. The world rewards people who look confident, but markets reward people who are cautious. There is a difference between confidence and arrogance. Confidence comes from preparation and limits. Arrogance comes from ego and ignorance. One survives, the other eventually self-destructs. If you want to avoid losing money, you must become comfortable with not knowing. You must resist the urge to have an opinion on everything. You must accept that passing on opportunities is not a failure. It is often the correct decision. Overconfidence tempts you to act. Humility gives you permission to wait. Over long periods of time, waiting beats acting far more often than people realize. Staying inside your circle of competence will not make you exciting. It will make you durable. And durability, not brilliance, is what allows compounding to work uninterrupted. One of the most persistent mistakes people make is believing that complexity equals intelligence. They assume that if something is difficult to understand, filled with jargon, or supported by elaborate models, it must be superior. In my experience, the opposite is usually true. Complexity is often a sign that the person involved does not fully understand what they are doing. Simplicity is not ignorance. Simplicity is clarity earned through discipline. Over long periods of time, simple systems survive stress better than complex ones. This applies to investing, to business, and to life itself. The more moving parts a system has, the more ways it can fail. When conditions are calm, complexity hides its weaknesses. When conditions change, those weaknesses surface all at once. That is why complicated financial products tend to perform worse during crises, precisely when people need them to work. I have seen brilliant people design intricate strategies that looked flawless on paper and collapsed under real-world pressure. The problem was not intelligence, it was fragility. Simple approaches may look unsophisticated, but they are easier to understand, easier to monitor, and easier to stick with. That matters more than theoretical optimization. An investment strategy that you abandon at the first sign of discomfort is not a strategy at all. It is a liability. Simplicity increases the odds that you will behave rationally when it matters most. Complexity gives you more reasons to panic. Another danger of complexity is that it feeds ego. People enjoy feeling smarter than others. Complex explanations make that easy. They create the illusion of control and mastery. But markets do not reward illusion. They reward results. If your reasoning cannot be explained in plain language, you should be suspicious of it. The same applies to personal finances. People complicate their lives with unnecessary expenses, obligations, and commitments, then wonder why they feel trapped. A simple financial life with low fixed costs and clear priorities provides resilience. When income fluctuates or markets fall, simplicity gives you room to adjust. Complexity leaves you cornered. Warren Buffett and I have always preferred businesses with straightforward economics. We like products people understand and continue to buy without much thought. We avoid situations where success depends on precise forecasts or perfect execution. Forecasts are unreliable. Execution is imperfect. Simple businesses tolerate both. They do not require constant intervention to function. That allows compounding to work quietly in the background. Complexity also increases the temptation to tinker. When a system is complicated, people feel justified in constantly adjusting it. They believe activity equals improvement. In reality, most changes introduce new risks without improving outcomes. The best decisions often look boring because they do not require frequent action. They require restraint. Simplicity supports restraint. It removes excuses for unnecessary movement. Another overlooked benefit of simplicity is transparency. When things go wrong, it is easier to identify the cause and correct it. Complex systems obscure responsibility. When no one understands how something works, no one knows how to fix it. That is how small problems grow into large ones. I have always believed that if you cannot explain why something should survive adversity, you should not depend on it. Survival is the ultimate test. Anything that only works under ideal conditions is not worth building a life around. Simplicity increases survival odds because it reduces dependence on favorable circumstances. People often resist simplicity because it feels limiting. They want flexibility. Ironically, simplicity creates more flexibility, not less. Fewer obligations mean more options. Clear systems mean faster understanding when change is required. Complexity locks you into structures that are difficult to unwind. If you want to avoid losing money, you should be suspicious of anything that promises higher returns through cleverness alone. Cleverness fades. Arithmetic remains. Over long periods, simple arithmetic combined with disciplined behavior beats elaborate schemes driven by confidence. You do not need the smartest solution. You need the one you can live with for decades without self-sabotage. Simplicity makes that possible. It keeps you focused on what matters and indifferent to noise. In a world obsessed with sophistication, choosing simplicity is not fashionable. It is rational. And rationality, applied consistently over time, is far more powerful than complexity ever will be. Most people spend their lives thinking like careerists, and then they wonder why their financial progress feels capped. Careerism trains you to trade time for money and approval for security. You climb ladders, collect titles, and polish resumes, believing that steady income equals safety. It feels responsible, but it also places a hard ceiling on outcomes. Time does not compound. Once a day is gone, it is gone forever. Selling hours means you are always starting from zero again tomorrow. Ownership works differently. Ownership allows results to compound even when you are not present. That difference is everything. When you own a productive asset, you benefit from its output repeatedly without having to recreate the effort each time. That is leverage without fragility. I learned this the hard way. I started my career as a lawyer, billing hours like everyone else. It was respectable and intellectually engaging, but it was also a treadmill. If I stopped working, the income stopped. There was no accumulation of momentum. That realization changed how I thought about money. I did not want my entire future to depend on continued effort and external approval. I wanted a structure that could endure without constant input. Buffett understood this instinctively. That is why we gravitated toward ownership of businesses rather than chasing salaries or prestige. Ownership aligns incentives with long-term outcomes. When you own something, you care about durability. You care about reputation. You care about compounding. Careerists often care about optics. They optimize for the next review cycle, the next bonus, or the next promotion. That short horizon leads to decisions that look good today and damage tomorrow. You see it everywhere. Companies chasing growth for appearances while eroding their core economics. Executives making acquisitions that inflate size but destroy value. Employees stretching lifestyles to match titles rather than building assets. Ownership thinking changes those behaviors. Owners ask different questions. They ask how this decision will look in 10 or 20 years. They ask whether it strengthens the foundation or weakens it. That mindset alone filters out a remarkable number of bad choices. Ownership also provides psychological freedom. When you own productive assets, you are less dependent on any single employer, market condition, or opinion. You can afford to wait. You can afford to say no. You can afford to be unpopular. Careerism rarely offers that flexibility. It encourages conformity and risk avoidance in the wrong places while encouraging dependence. People often confuse ownership with entrepreneurship. They think it requires starting a company or taking enormous risks. That is not true. Ownership can be as simple as holding equity in durable businesses or assets that produce cash over time. The key is alignment. When your financial progress is tied to the long-term success of something productive, compounding begins to work for you. When it is tied only to continued labor, it does not. Another trap of careerism is that it disguises fragility as stability. Paychecks feel predictable until they are not. Industries change, technologies disrupt. Organizations reorganize. When that happens, years of effort can lose value quickly. Ownership spreads risk differently. It does not eliminate uncertainty, but it allows gains from multiple sources to accumulate independently of your daily labor. That diversification of effort is powerful. I have watched many capable people reach later life with impressive resumes and very little financial independence. They did everything they were told to do. They just never shifted from earning to owning. The transition does not require recklessness. It requires intention. Saving consistently, reinvesting earnings, choosing equity over short-term consumption, thinking like an allocator rather than a spender. Ownership also encourages patience. You are less tempted to extract short-term rewards when you understand that long-term value is still building. That patience feeds directly into compounding. Careerism encourages immediacy. Ownership rewards restraint. This difference explains why two people with similar incomes can end up in completely different places over time. One spends to signal success. The other reinvests to build it. Titles fade. Assets endure. If you want to avoid losing money in subtle ways, you must examine how you think about your role in the economy. Are you selling hours or building something that can outlast you? The answer to that question will determine whether time works against you or for you. Ownership is not glamorous. It does not provide quick validation. What it provides is quiet accumulation. Over decades, quiet accumulation beats loud effort every time. One of the quietest ways people destroy their financial future is through lifestyle inflation, and it is quiet precisely because it feels like progress. Income rises and spending follows, almost automatically. Each upgrade feels justified. A better house, a nicer car, more convenience, more comfort. None of these decisions look reckless on their own. Taken together over time, they form a trap. Expectations rise faster than assets, and compounding never gets a chance to work. People believe earning more money will solve their problems, but earning more often just finances more complexity. I have seen this pattern for decades. Give someone a modest income, and they manage. Give them a large income, and they often become fragile. Obligations multiply. Fixed costs rise. Suddenly, a lifestyle that once felt like success requires constant motion just to maintain. That is not freedom. That is dependency wearing a nicer suit. The tragedy is that most people never notice the trade-off they are making. They feel richer, but they are actually narrowing their options. Every new expense commits future income. Every commitment reduces flexibility. When conditions change, as they always do, flexibility matters more than comfort. People often defend lifestyle inflation by saying they are rewarding themselves. That language is revealing. It assumes spending is the reward for effort. In reality, the real reward of effort is independence. Spending too much of that reward undermines its purpose. I have always preferred a margin of safety in my personal life, just as I do in investing. Living below your means is not about deprivation. It is about resilience. When your expenses are modest relative to your resources, downturns become inconveniences rather than disasters. You can absorb shocks without panic. You can make rational decisions instead of desperate ones. Lifestyle inflation removes that buffer. It forces people to keep earning at the same pace regardless of whether it makes sense. That pressure shows up everywhere. People stay in jobs they dislike because their expenses leave no alternative. They take risks they should not take because they cannot afford to slow down. They become anxious because there is no room to breathe. None of this improves quality of life. it degrades it. Another danger of lifestyle inflation is that it feeds comparison. As spending rises, it becomes more visible. Visibility invites comparison. Comparison invites envy. Envy invites poor decisions. The cycle reinforces itself. People stop asking whether something improves their life and start asking whether it measures up. That is how consumption becomes a scoreboard. Scoreboards are addictive. There is always someone ahead. Satisfaction never arrives. The irony is that many of the happiest people I have known lived far more simply than their means allowed. They were not trying to prove anything. They defined enough early and stopped chasing more. That clarity gave them peace. Peace is undervalued in financial planning, but it matters. You cannot think clearly when you are constantly worried about maintaining appearances. Compounding requires time, and time requires calm. Lifestyle inflation interrupts both. It diverts cash that could have been invested. It increases stress that clouds judgment. It shortens time horizons because everything feels urgent. People underestimate how powerful restraint can be over long periods. Every dollar not spent is not just saved. It is multiplied by time. Every habit of moderation compounds just like capital does. The effect is slow and invisible at first, which is why most people ignore it. They only see what they are giving up today, not what they are buying tomorrow. The math, however, is relentless. Small excesses, repeated over decades, become large losses of opportunity. I have always believed that enjoying living below your means is one of the most valuable skills a person can develop. Not enduring it, enjoying it. When restraint becomes part of your identity, rather than a temporary sacrifice, compounding accelerates. You stop feeling deprived and start feeling free. You are no longer racing to keep up. You are building quietly. Lifestyle inflation promises comfort. What it usually delivers is anxiety. If your goal is to avoid losing money in ways that cannot be recovered, then controlling lifestyle creep is essential. It is not about how much you earn. It is about how much room you leave for error. Room for error is where survival lives, and survival is what allows wealth to endure. People like to believe intelligence is the main driver of success, but over long periods it is temperament that decides outcomes. I have met plenty of very smart people who failed financially, and many average people who did remarkably well. The difference was not knowledge, it was behavior. Markets test temperament far more than they test intellect. They reward people who can remain calm when others panic, and punish those who cannot control their emotions. This is uncomfortable to accept because it suggests that self-control matters more than cleverness. Intelligence helps you understand ideas. Temperament determines whether you can live with them. The hardest part of investing is not finding a reasonable plan. It is sticking to it when the world is trying to knock you off course. Fear and greed arrive on schedule. When prices fall, fear tells you to sell. When prices rise, greed tells you to chase. Both voices sound persuasive in the moment. Both are wrong most of the time. The people who succeed are not the ones who silence those voices completely. They are the ones who refuse to act on them. Boredom tolerance is an underrated skill. Most people cannot stand long periods where nothing seems to be happening. They feel compelled to do something just to feel in control. That urge is expensive. Activity creates friction. Friction erodes returns. Doing nothing is often the hardest decision and the most profitable one. Temperament also shows up in how people react to being wrong. Everyone is wrong sometimes. The question is, what happens next? People with poor temperament double down to protect their ego. They defend mistakes instead of correcting them. Small errors turn into large losses because pride blocks adjustment. People with good temperament accept error quickly. They cut losses without drama. They move on. This difference compounds over time, just like capital does. Another aspect of temperament is consistency. Success rarely comes from a single brilliant decision. It comes from thousands of small, reasonable ones repeated over decades. That repetition requires emotional stability. If your mood determines your behavior, your results will be erratic. Markets amplify erratic behavior. They do not forgive it. Calm behavior, on the other hand, creates predictability. Predictability allows compounding to operate uninterrupted. Many people underestimate how destructive stress can be. Constant anxiety shortens time horizons. It makes everything feel urgent. When everything feels urgent, long-term thinking disappears. You start optimizing for relief rather than outcomes. That is how bad decisions get justified. A calm mind is a competitive advantage. It allows you to see clearly when others cannot. It allows you to wait when others rush. Temperament is also shaped by expectations. If you expect markets to be smooth, volatility will shock you. If you expect discomfort as part of the process, volatility becomes manageable. Preparation reduces emotional reaction. That is why I have always believed in setting realistic expectations. If you expect boredom, you are less likely to sabotage yourself when it arrives. If you expect setbacks, you are less likely to panic when they happen. People often look for techniques to improve performance. They ignore character. Character is what remains when techniques fail. During crises, models break and forecasts collapse. Temperament remains. The ability to sit quietly and do nothing while others are losing their minds is rare. That rarity is rewarded. I have watched markets transfer wealth from the impatient to the patient over and over again. The mechanism is simple. Impatient people act at the wrong times. Patient people wait. Waiting allows probability to work in their favor. Temperament also influences how people define success. Those who need constant validation tend to trade stability for excitement. They want to feel smart. They want to feel ahead. That need drives unnecessary risk. Those who value peace of mind are content to look boring. They do not need constant confirmation. That independence protects capital. If you want to avoid losing money over a lifetime, you must design your behavior to withstand boredom, uncertainty, and criticism. Intelligence will not save you when emotions take over. Temperament will. It is not glamorous. It does not show up on resumes. It rarely gets credit. But it determines whether all the other pieces have a chance to work. Over long stretches of time, calm beats clever, patience beats activity, and behavior beats brains. Who you choose to deal with matters far more than most people ever admit. And over a lifetime, it often matters more than intelligence, education, or opportunity. A large share of permanent financial damage does not come from bad markets or bad luck, but from bad people. Character compounds just like capital does. So does the lack of it. Honest, rational people quietly reduce risk year after year. Dishonest, impulsive, or ego-driven people introduce hidden liabilities that eventually surface, and when they do, the cost is often irreversible. I have seen strong businesses ruined, not by competition or economics, but by the people running them. The numbers looked fine. The strategy sounded impressive. The weakness was character. Dishonesty, arrogance, and incompetence always reveal themselves with time, and when they do, they rarely arrive alone. They bring lawsuits, reputational damage, internal decay, and distraction. That is why integrity is not a soft virtue. It is a hard requirement. Intelligence without integrity is dangerous. Talent without character is unstable. Money does not correct these flaws. It magnifies them. When people gain access to capital, they do not become better versions of themselves. They become more of what they already are. Discipline scales, recklessness scales faster. That is why a promising deal with the wrong partner is not a good deal. It is a delayed disaster. Missed opportunities fade. Bad partnerships linger. They drain energy, consume attention, and waste years that could have been spent compounding quietly. I learned early that it is better to walk away from a decent opportunity than to proceed with someone you do not trust fully. Warren Buffett and I shared this belief. We did not just look for smart people. We looked for people we liked, admired, and trusted. That simple filter eliminated more risk than any legal contract. Trust reduces friction. When trust exists, you do not need constant monitoring or defensive behavior. You can focus on building instead of protecting. The absence of trust creates short-term behavior. People hide information. They optimize for themselves. They take what they can while they can. That environment is poison to long-term success. Incentives matter as much as character. People behave in line with how they are rewarded. If incentives favor short-term gains, you will get short-term thinking. If they reward durability, patience becomes rational. This is why ownership matters. Owners feel the consequences of bad decisions. Careerists often do not. They can collect rewards today and leave problems for someone else tomorrow. When you invest, you are betting on human behavior as much as numbers. Financial statements show the past. People determine the future. Another underestimated cost of bad people is drama. Conflict consumes attention, and attention is limited. Every hour spent managing disputes is an hour not spent thinking clearly. Drama injects emotion where logic should dominate. Once emotions take over, rational decision-making collapses. I have avoided unnecessary drama because chaos is expensive. Stability gives compounding room to work. Chaos interrupts it. This applies outside business as well. Divorces, lawsuits, and feuds are among the fastest ways to destroy wealth. They rarely come from bad luck. They usually come from poor judgment about people. Choosing carefully early prevents years of damage later. Another critical trait is humility. People who cannot admit mistakes tend to repeat them. They punish dissent and surround themselves with agreement. Reality eventually pushes back. Businesses fail. Partnerships collapse. Capital disappears. Humble people listen, adjust, and survive. I have seen organizations with enormous resources collapse simply because leaders cared more about ego than truth. If you want to avoid losing money over a lifetime, pay close attention to character. Not words or promises, behavior. How people act when things go wrong tells you everything. Do they accept responsibility or shift blame? Do they learn or repeat? Do they think long-term or grab what they can? These traits determine outcomes more reliably than talent. Compounding works best in environments of trust, stability, and shared values. When those exist, mistakes can be absorbed and corrected. When they do not, even small problems become fatal. Choosing the right people is not about being clever. It is about being selective. Fewer relationships, higher quality, less noise, more alignment. Over decades, that selectivity quietly multiplies results. The wrong people can undo a lifetime of discipline. The right ones make compounding possible. If you strip everything down to what actually matters, the formula for not losing money is far simpler than people want it to be. That is precisely why it is ignored. People search for complex answers because simple ones feel unsatisfying. They want a trick, a secret, or a special insight that sets them apart. What they do not want is discipline applied consistently over a long period of time. Yet discipline is the only thing that reliably works. Over decades, wealth is built less by what you do and more by what you refuse to do. You refuse excessive debt. You refuse unnecessary risk. You refuse to play games you do not understand. You refuse to compare yourself to people whose lives you do not want. That refusal compounds quietly. Most financial disasters are self-inflicted. They are not caused by bad markets. They are caused by impatience, envy, ego, and the inability to sit still. People interrupt compounding because they cannot tolerate boredom or uncertainty. They trade long-term safety for short-term excitement. They convince themselves that activity equals intelligence. It does not. Often, it equals fragility. I have lived through enough cycles to know that the world does not reward cleverness as much as it rewards survival. You do not need to be brilliant to win. You need to avoid being foolish for a very long time. That means accepting that mistakes will happen but refusing to make the kind that end the game. Lose small if you must. Never lose big. Capital that survives has a remarkable ability to heal and grow. Capital that is destroyed has no second chances. People underestimate how forgiving time can be when you give it something solid to work with. Compounding is relentless, but only if you let it run uninterrupted. Every major principle we have discussed points back to the same idea. Avoid fragility. Fragility shows up in many forms. Debt that forces action. Spending that leaves no margin. Ego that prevents learning. Complexity that hides risk. bad relationships that drain focus. None of these things improve your life. They narrow it. Strength comes from simplicity, humility, and patience. Those qualities are not celebrated. They do not trend, they do not make good stories, but they work. Over long periods, the people who build enduring wealth are the ones who look boring while everyone else is chasing excitement. They save consistently. They invest rationally. They wait. They ignore noise. They define enough and stop moving the goalposts. They do not need to win every year. They only need to stay in the game. That mindset is rare, and rarity is rewarded. Many people believe staying rich is harder than getting rich. In reality, staying rich is easier if you do not change your behavior when the numbers grow. Most people fail because success alters them. They take bigger risks. They inflate their lifestyles. They start believing the rules no longer apply. That belief is expensive. The rules always apply. Arithmetic does not care about your confidence. History does not care about your intentions. If you want to never lose money in a way that matters, you must accept that humility is protective. You must design your life so that bad outcomes are survivable. That is not pessimism, it is realism. Optimism belongs in the belief that steady effort over time will be rewarded. Pessimism belongs in the assumption that things can go wrong. Holding both at once keeps you sane. I never aimed to be extraordinary.
I aimed to be reasonable. I aimed to avoid obvious mistakes.
I aimed to live in a way that allowed me to sleep well at night. The results came as a byproduct of that approach. That is the part people miss. Wealth is often an unintended consequence of doing many small things right and refusing to do a few very damaging things wrong. If you remember nothing else, remember this. The first rule is do not lose. The second rule is do not forget the first rule. Everything else is optional. Survival is mandatory. If you can manage that, time will do the rest.